Bond yield surpassing 5% following Moody's recent downgrade of the US's credit rating. We're witnessing a pivotal moment for investors, but the nominal yield itself is not really the big story. In this video, we'll take a look at the implications of rising yields, the dynamics of debt to GDP, and how nominal growth trends are progressing compared to yields and the implications. So, here in white is the 30-year bond yield, just the overall nominal yield. And then in red, we have consumer price inflation. This is the year over year change of inflation in red. And then in purple, we have real GDP. This is inflation adjusted, right? Removing money printing, which can give an illusion of growth. This is removing that component and just what is the real actual growth after you take out money printing. And that's what we see here in purple. And what I want to point out, a lot of people are pointing to this period of time in 2023, late 2023, when the 30-year bond yield hit 5.1%. They're looking at it hitting 5% today, and they're going, "Oh, no big deal. We hit 5% in late 2023." What I want to point out with this chart is that the components of the bond yield, right? Remember what the bond yield is supposed to approximate nominal GDP. Well, what is nominal GDP? It's a real growth, which is the purple line, plus inflation, which is the red line. And those are the two of the main components in the bond yield. And what we can see is during that period of time in late 2023, real GDP was growing at about 3% a year, and currently, it's growing at 2% per year as of the most recent data. You go look at the other component, which is inflation, and inflation was also higher. CPI was running at about 3.6% year over year, and it currently is running at 2.3%. So inflation is 1.3% lower, and real growth is also over 1% lower. So you would think that bond yields would be lower because those are two of the main components that go into what the bond yield is supposed to represent. Well, there is a third contributor or component, and that's called the kind of premium. And this is what we see here in purple. Now, these are not the same scale, so it looks like this real yield is close to 5%. You have to look over here to the far right. This is the scale for this purple line. But what I want to illustrate is that the direction of travel appears to be the same as the 30-year yield. So even though these kind of major components, growth and inflation, are falling, right, recently, the bond yield and the premium that investors are demanding. This premium the way you calculate it, or one of the ways you can calculate, is take the 10-year treasury yield and then subtract the expected inflation rate. And so that's what this T10YIE, that's the 10-year break even. So you take the nominal 10-year yield and then you subtract out what the market is pricing for inflation. That gives you the kind of premium in addition to inflation that the bond market is demanding. And we can see that this purple line, again, the direction is what matters, the shape of it. It has been following the 30-year higher. So the premium that the bond market is demanding, in addition to, we know that growth and inflation are both falling since 2023, the last time the 30-year hit 5%. These two major components are falling. So why is the 30-year rising? Well, that's what this purple line shows. This dark purple line shows the premium above and over inflation. So here, implications of that. So here in red, we have debt to GDP. And then down here in white and these purple lines, we have nominal GDP. Again, that's what a bond yield is supposed to approximate. And so then in these different shades of purple, we have the 10-year yield and the 30-year yield. So the 30-year is the lighter purple, kind of pink. 10-year is kind of the darker purple. And what I want to point out here is the relationship that this has to debt to GDP. So remember, debt to GDP, another way to think about this red line is its debt, total government debt divided by GDP. It's probably an easier way to think about it. So this white line, this is nominal growth. If you are the government and you are able to run nominal growth above the cost of debt, right, which is these purple lines, that's a good deal for you because you're able to grow the denominator faster than the cost for the numerator. This is also true in the opposite sense, which is when nominal growth, which is again inflation plus real growth, when that nominal growth falls below the cost of the debt, that's not good. And we can see that, periods of time where this has happened, here, kind of in the dot com bubble, and this was mainly because GDP was falling because it was a recession. And then here again in the great financial crisis, we know GDP really fell. Um, we can see that this nominal growth number fell below the cost of the debt, right? So the government had to pay, call it 4.2%. This is locked. All three of these lines are locked to one scale. And so during the great financial crisis, the government was paying 2.8 to all the way up to kind of 3.5. I mean, the 30-year was trading as high as 4.5, but we see nominal growth was negative 5.8%, right? That is not good for a government. You are being forced to pay that. Put another way, the real yield is very, very high. You are paying the cost of the debt, right? The interest rate on all the debt is way higher than the nominal growth. Remember, the nominal growth is basically the kind of health of the overall economy. The GDP is what allows the government to service its debt because GDP is the economic activity off of which the government can tax. So if you're the government, you want GDP really, really high, and the cost of your debt really, really low. And in that situation, that's called negative interest rate. In that situation, your debt to GDP will actually decline. And so here I want to point to a period of time where nominal growth, this is kind of the mid 90s. We can see here in red, debt to GDP was declining, right? Because nominal growth, the white line, was higher than the cost, the interest rate on the debt. We can see that for this entire period of time, nominal growth was higher than the cost of the debt. And then, sure enough, what happened? Nominal growth fell in dot com, and it actually crossed below the cost of the debt. And what do we see? Debt to GDP starts moving higher, right? Because the cost of the debt is becoming more of a burden for the government because that GDP, the inflation, the nominal GDP, is not high enough, right? The government is forced to pay a premium, so this debt to GDP actually increases, and this is the relationship that I think is really important. And what we can see is that, generally speaking, the government has been able to run nominal GDP above interest rates. Now, this doesn't guarantee just being able to have the white line above the cost of the debt does not guarantee that your debt to GDP will go down. Um, so I want to make that point clear. It's about the kind of the rate, the degree to which certain things are changing. But again, here's another example where we all kind of know what happened in 2020. Nominal growth fell off a cliff, right? At the height here, nominal growth was the economy, nominal GDP was contracting at 6.9%. And the cost of the debt was between for the 10-year was about 74 basis points, and for the 30-year was about 1.5%. And here in red, we can see debt to GDP spiked higher, right? And went all the way up to 133%. Well, what happened kind of after that period? Well, nominal growth recovered, right? We started printing a bunch of money, stimulating the kind of aggregate economic activity. Sure enough, nominal growth rebounded very, very sharply. And we can see nominal growth skyrocketed higher, right? It went way over the cost of the debt for the 10-year and the 30-year. And sure enough, what happened to debt to GDP? It declined, right? This entire period of time, the white line is above the cost of the debt. Nominal growth is above the cost of the debt. Another way to put this is inflating the debt away or financial repression. And we can see that it worked, right? Debt to GDP came down from 133% to at its low here, 115%. Well, what's been happening since then? Since that time, since this kind of bottom in mid 2023, debt to GDP has been kind of grinding higher. It found that bottom at 115, well, 115%, and it is currently 121%. Well, what have we seen since that time period? We've seen bond yields move higher and nominal growth move lower. And in fact, what I really kind of want to really point out is the cost of debt, the interest rates are moving above nominal GDP. And we can see that here. Now, for some reason, the way TradingView displays this, whatever the last data point is it pulls all the data back to that whatever the data was at that time. And so the last data point on this chart is April 30th, not May 19th. So these bond yields are actually even higher than what this chart suggests. But hopefully, the kind of illustration is clear, which is nominal growth has been falling and bond yields have been rising. So again, remember, those are two of the three components. The third component is this kind of premium, which we can see in the purple line, which has been following, at least directionally, very close. This premium is basically what investors are demanding above inflation in order to buy the bonds. And typically that'll be higher the longer duration the bond is. If you're worried about inflation and fiscal situation of a government, a 5-year bond, you're not as worried as you are when you're locking in a contract, a 30-year bond, right? 30 years is a long time. So the premium will be higher. This is generally why, the longer term bonds trade at higher yields. Currently, the 30 years about 5% and the 10 years about 4.5%. This is why that is because, the longer the duration of the bond, the more at risk the bond investor is for things like inflation. And bonds have some, the convexity component to them as well. So here is kind of yet another way to look at it. Here in white, we have debt to GDP in white. And then this baseline chart is the real yield. And the way I calculated this baseline chart is by taking the 10-year treasury minus CPI. And what we can see is that, there are periods of time where we had negative real interest rates, right? And in the great financial crisis, a negative real interest rate doesn't necessarily mean that your debt to GDP will decrease. It depends, again, on the rate of change of the various components. But in general, what I want to point out is this period of time here where we had really negative interest rates, really negative real interest rates, and we can see that the debt to GDP declined. I'm not sure why this keeps moving. There. This is generally speaking what the government wants, right? At its peak in the 80s, this real yield was 9.7%. So the government was being forced to pay 9.7% in addition to inflation. That's a pretty high premium for the government. And what did we see? Kind of in general, since that period of time, this premium has been falling. And there are periods of time where it falls enough that debt to GDP can decrease. There are periods of time clearly where, like, we see this spike here in the real yield during the great or following the great financial crisis. We can see that the premium spiked to as high as 5.7%. Now, again, remember, this is mainly due to that GDP component falling so fast, right? That is why this premium spiked so much, is because inflation went negative, right? Which is where you're taking the 10-year yield and minusing inflation. So if inflation goes negative, this real yield is going to spike. But the effect on debt to GDP is what really matters, which is debt to GDP. Clearly we issued a lot of debt during the great financial crisis and the aftermath, and debt to GDP rose, right? And so this real yield has been rising. It set a bottom in, call it May of 2022, June of 2022. And sure enough, what do we see with debt to GDP? Debt to GDP has been moving higher as this real yield, this premium, in addition to inflation, as this has been moving higher, debt to GDP has been moving higher. Debt to GDP set a bottom at 115%, and is currently, as of the last data, 121%, and that corresponds to this real yield rising. And so this real yield is really what the government is worried about. Why would bond investors be demanding a higher premium to buy bonds? Well, if you're worried about the fiscal outlook of a country, if you're worried that deficits are going to increase, remember, if you're a bond investor, remember the value of the bond is inverse to the yield. If you are, an investor in, say, Apple, let's make it very simple. You're an investor in Apple, and you hear that Apple company is going to come out and issue, you know, they're going to double the number of shares, right? And they're just going to dump them on the market. Well, that's a huge increase in the supply of Apple stock in the market, right? So, given constant demand, supply and demand would dictate that the price of your Apple shares is going to fall pretty dramatically if they're doubling the supply. It's really no different with bonds. When the deficit is increasing, another way to put that is that bond supply is increasing, right? Because the deficit, in order to cover that deficit, when you hear the fiscal deficit talked about, the way that we finance that is by issuing debt. And so as that deficit rises, the amount of debt, the amount of bond supply must increase. So if you're a bond investor, this means that, the value of your bonds, unless demand comes in, really hot and increases for some reason, the value of your bonds is going to fall because the supply is increasing because the deficit is rising. They must issue more and more debt, right? Try to push more and more debt into the market. And this is, I think, why bond yields are rising. We can see that trend clearly. Nominal growth has been coming down for years now. And what do we see? For the past couple of years, bond yields have been rising, and in fact, now are actually above nominal growth. And so, debt to GDP. We've talked about this in previous videos, but as debt to GDP increases, uh, it has a deleterious effect on the denominator, on GDP. As debt to GDP increases, the productivity of each dollar of debt goes down, right? So you're issuing more and more debt, trying to get GDP, but the more debt you issue, the less GDP you actually get. And so you get stuck in this cycle of issuing more and more debt and getting less and less GDP in return. And I've shown, debt over GDP. That chart shows basically the marginal productivity of debt. And as this debt to GDP increases, you get less and less GDP with each new dollar of debt that you issue. And so this is really the pain point. This is, I think, what really matters in this conversation about bond yields. And then finally, here, just the shape of the yield curve. Here is when the Fed started to cut interest rates in September of 2024. Remember, growth was higher. This purple line, let's go back to September of 2024. Growth was higher. This real growth number was higher, and inflation was higher. But the Fed started to cut rates, and what happened? Bond yields went up, especially at the long end of the yield curve. And this is what's called a bear steepener. So there's two types. There's flattening of the yield curve, and there's steepening of the yield curve. And then within each one of those, there is a bullish way that it happens and a bearish way that it happens, right? If you are a bond investor, a steepening of the yield curve doesn't inherently, that's not inherently a bad thing, right? There are bull steepeners that are bullish for bonds. This is where everyone is buying all the bonds, right? 2-year, 10-year, 30-year, everyone is buying all the bonds. but they're really buying the 2-year bond. That means the 2-year bond yield is falling faster than the 30-year bond yield. That is a steepening of the yield curve, but it's bullish, right? Because all the bond yields are falling. Well, the opposite side of that is also true. There's a bear steepener where the yield curve steepens, but it's because all the rates are rising, right? Everyone is selling all the bonds. So all the bond yields are rising, but the longer ones are rising faster than the shorter ones. And that's kind of what we see here. And hopefully that this kind of period of time makes that clear, where you can see that the 30-year, especially the 30-year, has been moving. The difference between, you can see they kind of moved in tandem here, right? Through this period of time of kind of late 2024, bond yields kind of across the curve, they all moved higher, and they moved higher at about the same rate. But what do we see here? We see that, they start kind of diverging, right? The 2-year, going back to call it March of this year, the 2-year is flat, perfectly flat. The 10-year is up marginally, right? But the 30-year is really up. And you can see this delta starting to increase. You can see that the 30-year is really starting to kind of rise faster than the 10, and especially faster than the 2. So what does this mean? Well, bear steepener in the name is bearish for bonds. It is not a good outlook for bonds. Um, why does that happen? Well, one of the main reasons a bear steepener happens is concerns about the fiscal situation or the fiscal health of a government. We know that the deficit for fiscal year 25 is 11% higher than the deficit for fiscal year 24 at the same point in time. So again, if you're a bond investor, remember that means more supply is being shoved on you, right? And we talked about the Apple analogy. As that increase in supply, if demand is constant, that means the value of the thing you hold is going down. And because bond yields are inverse, that means bond yields go up. And at the same kind of period of time, we have the trade issues, right? All the kind of hostility and kind of upheaval in the kind of global financial order, and a lot of capital repatriation, where foreign money that has been pouring into our various markets is going, okay, you don't want us, we'll go home. We'll go, we'll sell our US bonds, and we'll buy our own. We're Japanese, so we'll buy the Japanese bonds. We're German, so we'll buy the boons. This capital repatriation has been going on since at least February. That was when I first started to notice it, way before kind of anyone was talking about it. You could see elements of it kind of starting in February, but it really kind of took off in March and April. So you have demand falling, right? We established that the supply is increasing because the deficit is worse for fiscal year 25. That means the bond supply is higher. And at the same time, you have demand lower. And demand for longer term bonds, appears to be, just from the shape of the yield curve, significantly lower than the supply. That is why these longer term bond yields are rising faster than the shorter term bond yields, right? There appears to be, since that kind of period of time in February, you can see the 2 years basically flat. So now, of course, there are caveats here with issuance across the curve, right? How much is the treasury issuing of 2 years, of 10 years, of 30 years? That distribution can also play a role here, and the quarterly refunding announcement. Those will be very important. But just generally speaking, I want to try to hopefully illustrate kind of the general idea here, which is, the demand for the longer out you go, the more investors are kind of requiring a higher yield to get them enticed. They're perfectly fine buying the short end of the yield curve, right? 2-year, because if you're a bond investor, okay, yeah, maybe there's a year or two of inflation, right? Because the government is getting over indebted. The fiscal situation's bad. So they're going to try to inflate their way out. But you're only holding a 2-year, you're only holding that bond for 2 years. So yeah, maybe you lose money one of those 2 years, but you're okay. If you're holding a 30-year bond, you become much more concerned with inflation, right? And these negative real rates and them trying to inflate their way out of the debt. And I will point out, just to close here, Scott Bessent mentioned on one of the Sunday shows, I think it was the Fox Sunday show, mentioned this exact dynamic. He mentioned growing nominal GDP faster than the cost of the debt. This is essentially, growing your way out of the debt. But remember, nominal GDP includes inflation. So the other way to think about this is that, to some degree, you're kind of inflating your way out of the debt by running negative real rates, as we see here. During this period of time of 2021, we ran significantly negative real rates. And sure enough, debt to GDP came down. So if you're the government, that's great. Now, the problem is getting the bond market to agree to losing money, right? Uh, if the bond market thinks negative real rates, right? If the government thinks, oh, they're going to run the economy super hot and try to inflate their way out of the debt, they're going to demand a higher and higher yield, right? Because they are trying to protect themselves from that eventuality, from this eventuality. Because remember, at the peak here, bond investors were losing 6% a year. Um, and so, no investor wants to lose 6% a year. And so, generally speaking, the bond market kind of sniffs this out and is able to, telegraph this or see this coming. And I think that is why we are seeing this kind of bear steepening of the yield curve. I think that's why bond yields are moving above nominal growth. I think the bond market understands, right? They see this tax bill, they see the deficits, they see all this stuff going on, and they kind of know the playbook, and they don't want to get into a situation of negative 6% interest rates, right? Where you are guaranteed to lose 6% a year. They don't want to get into that scenario. So they are demanding higher and higher rates above inflation, right? That is what this line kind of curling up, that is what that indicates, is that they are demanding higher and higher premium in addition to inflation in order to buy these bonds. And what this indicates is that phenomenon is especially pronounced the longer out you go. Now, Scott Besson, as mentioned, been critical of the previous administration, who, shifted a huge amount of issuance towards the front end of the yield curve into what's called bills. This is shorter term bonds, right, like a 3 month or 6 month. Besant was very critical of that. A year or two ago when it was happening. Well, since becoming Treasury Secretary, he's basically kind of backtracked and gone, well, yeah, no, I think that we're going to keep Janet Yellen's approach of issuing mostly bills, and I think he's smart enough to see that, look, if they want to issue the way they used to, when debt to GDP was much lower and the bond market was not so worried about the fiscal outlook, it's a different world now. And, why would they want to issue 30-year 30-year bonds at 5% when they could issue a 2-year bond at 4%? Well, of course, some amount of kind of buffering is good, right? You want to try to spread out your issuance. This makes you less kind of sensitive or susceptible to overnight short-term interest rate changes, with the Fed. But, if the if the 30 year is gonna move higher to 5% and then 5.5%, right? And the long end of the yield curve keeps moving higher, indicating there's not much demand out at the longer end of the yield curve. He is going to probably keep issuing at the short end where there is demand. And not only demand, but lower rates, right? Remember, the value of the bond is inverse to the yield. So another way to put it is, here's the value of the 2-year in teal. Here's the value of the 10-year in blue, and then the value of the 30-year in purple. And maybe this illustrates it kind of more clearly. We can see, the value of the 2-year bond has basically trended significantly higher here, and at least since kind of March has been flat. Well, the 30-year is down, right? So the value of the longer term bonds has actually fallen during that time period. The 10 years fallen very marginally, but the 30 years really kind of fallen. And so I think that all of these dynamics are important. It's not just the interest rate itself, but it's all the components. It's the relative changes, right? real yields, right, versus positive real yields, nominal growth. What is that doing? What is inflation doing? You have to take the whole thing into account. You can't just look at the nominal yield and go, oh, 5%. That's not good. Or 5%. That's great. You have to look at it in the context, the shape of the yield curve. What is nominal growth doing? What is real growth doing? What is inflation doing? Right? All of these sorts of things. Is there term premium? Okay, how much term premium is being required by all of these things matter, in my opinion, much more than just the overall yield. So hopefully that was helpful. There's probably still a lot to go over, but trying to keep this short.